Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking a few minutes out of your day to watch this weekly stock market update and industry sector review for the week ending Friday, June 28th, 2018. As you can see, I'm back in my office recording this video because I tried to take the camera outside again this week, and it simply isn't happening. It was 95 degrees out there right now, and I felt like I was sitting in an oven even when I was in the shade. So let's just go ahead and get started with this video, and I'll begin with the quote of the week. This week's quote is from Mahatma Gandhi. You probably know his name, but you may not know all the details about him, so here are a few facts. Mahatma Gandhi was born 1869, died 1948. He was an Indian activist who was the leader of the Indian independence movement against British rule. Employing nonviolent civil disobedience, Gandhi led India to independence and inspired movements for civil rights and freedom across the world. Gandhi once said, "The future depends on what you do today." Those are some very powerful words from Mahatma Gandhi. Well, let's just go ahead and jump right into those charts. It has been an incredibly volatile week since the last video. The Dow Jones Industrial Average was down about 500 points for a while on Monday, the 25th of June, closed down about 350, and then Tuesday was a very quiet day in the markets, but it looks to me like it's setting up for lower prices for the Dow Jones, the S&P 500, and the Nasdaq 100. So let's go ahead and take a look at those charts, beginning with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average, you can see that we began a new downtrend that started on June 12th, and the Dow actually had 8 down days in a row, which it hasn't had in 40 years. So that is an interesting thing to be aware of and to keep an eye on. You can see the red line here, which is the 5-day moving average, has crossed below the blue 20-day moving average, indicating a short-term weakness signal, and the 20-day moving average is still above the 50, and they're the 50-day moving average in purple, and they're really just trending sideways to each other, it looks like. So that indicates some indecision, but the 20-day average is still above the 50, leaning more toward the strength on the intermediate term time frame for now. Now, looking at the support and resistance lines for the Dow Jones, you can see that the highs, or the high of March 9th right there, was the resistance line that I was expecting would be difficult for the Dow to get through. And sure enough, the Dow rallied up, got to the line, and then rolled over and fell pretty quickly over the last couple weeks. So right now, that resistance line is very strong and has been tested twice before, once on March 9th, and actually we got up to there through the day on February 16th. So it's tested it once, twice, 3 times throughout here, and it failed again to hold here and rolled back down. As far as support for the Dow Jones Industrial Average, take a look at this. If you connect the lows of March 23rd and draw that up there, you can see that the Dow was kind of bouncing off this line. We touched it once, twice, 3 times, 4 times, 5, and we broke through that support line on March 20th or 21st, June 20th or 21st, and now we're heading lower again. So it'll be interesting to see if the Dow can stop its decline. The one thing that it did give it some support this week is the 200-day moving average. And if I switch that on, you can see it's a green line here. We came down and hit that 200-day moving average, which is a very important number in the investment world. 200-day moving averages typically provide good support. And sure enough, we came down, closed below it, but closed below it on the 25th, but closed right on it on the 26th. So right now, the 200-day moving average is still holding, but I recommend a lot of caution regarding the Dow Jones Industrial Average. I mean, down 8 days in a row, down 500 points on the 25th of June. Those are some pretty powerful facts and figures, and they're all leaning towards some bearishness. So keep an eye on the Dow and just be cautious with this particular index. Here's the chart of the S&P 500 stock index, and you can see it's also in a declining trend that began on June 12th. Showing you the moving averages real quick. The 5-day moving average in red crossed below the 20-day moving average in blue on June 25th, indicating a short-term weakness confirmation. But right now, the 20-day moving average is still kind of pointing up and away from the 50-day moving average. So the S&P 500 is definitely stronger than the Dow Jones, but we'll just keep an eye on this at this time. Just a little bit of caution is needed because of the fact that this 5-day moving average is pointing down pretty steeply, and we had a very significant sell-off over the last couple weeks here. Looking at the support and resistance lines, taking a look at first the resistance, that comes back to this particular line right there, which is the high of March 9th and the high of February 26th. That again was going to be very difficult resistance for the S&P to get through because of these two prior reversals. And sure enough, the S&P rallied up, hit that line on June 12th, and then rolled over to the downside, and also has broken through support. The support for this particular S&P 500 index is this line right there, connecting the lows of May 3rd and May 29th, and we broke through that on the 22nd of June and bounced right off of this purple 50-day moving average. Actually came down, hit the 50-day moving average, and bounced off it a little bit. So over the next few days, I'm going to be watching this to see if we get continued sell-off into Friday's close. So use a little bit of caution right now and keep an eye on this for any strength in the S&P, but I am guessing that we are likely headed to lower prices on the Dow and the S&P 500 for now. So just use caution. Here's a chart of the Nasdaq 100 stock index, and this is the strongest index of the bunch. You can see that we came up here and hit a high on June 14th and on June 20th, and have since sold off pretty steeply. The 5-day moving average crossed below the 20-day moving average in blue on June 26th. So that is a trigger of a short-term weakness confirmation, or basically just use some caution. Keep an eye on this thing because it is extremely tired from running all the way up here from the lows of April all the way up here to the highs of June. So the other thing that is very bearish about the Nasdaq 100 at this time is the fact that we have failed to hold the breakout. The breakout of March 12th, we took that out on June 4th. We broke through to new highs on June 4th, rallied all the way up here, and then over the last week, we have failed to hold that breakout up here, and now we're back below this high of March 12th. That is a very bearish sign for the Nasdaq, because that means that this breakout was probably a false breakout, and we need to keep a very close eye on it. This is the other remaining high right here that I'll mark, which is the high of January 26th. This is the last remaining support line for the Nasdaq 100. If we break it, that means that the door opens to much, much lower prices for the Nasdaq. As you can see, if you draw that line from the high of January 26th, we came flying through the prior high and then bounced right off of that high from January. And on the 26th of June, we had a little bit of a rally, but the prior day, June 25th, was a very severe sell-off and had lots of selling volume behind it. So I suspect that we will see lower prices for the Nasdaq 100. And if this red line across here breaks, then look out below. That could get very, very bearish very quickly. So use caution when considering the Nasdaq 100. Looking at this chart of the S&P 500 Information Technology Stock Index, you can see that the 5-day moving average in red is crossed below the blue 20-day moving average as of June 25th, it looks like, indicating a short-term weakness signal. And the 20-day moving average in blue is still well above the 50-day moving average in purple, which still gives us a lot of intermediate term strength. And again, what I mean by that is short term is days or hours to days, while the intermediate term is days to weeks. So longer time frame to consider moves in these particular indexes. We had a false breakout, it looks like, and we're back in the lower range. This high right here, March 12th, was the prior high that needed to get broken. We tried one more time on May 10th but failed, but we did succeed in breaking that on about June 1st or May 31st. Rallied up here, but we have since fallen back down below that prior high. So we may have a situation of a false breakout and some more bearishness coming forward in the technology stocks in the weeks ahead. One thing that I pointed out, I believe, in the last video is this is what technical analysis calls a bearish rising wedge pattern, where you have a converging pattern, converging prices. So you can see that those two red lines were getting narrower and narrower, and typically a bearish rising wedge fails 3/4 of the way down the length of the wedge, and sure enough, we got a little further maybe than 3/4 by a hair, but we failed and then sold off rapidly until June 25th, the day before this video is being made. So we have some serious bearish signals coming out of this technology index right now, so just use some caution. I mentioned in my last video that the consumer staples stock index was probably my favorite chart currently, and you can see the high that was made on January 26th in this consumer staples index. From January 26th to the lows of, looks like May 2nd or May 3rd, the consumer staples stock index fell 17.3%, and that is a long drop for companies that make some very valuable products. These are the companies that make, soup, toilet paper, laundry detergent, all the primary food and beverage, soda pop, juices, things like that. And for this stock index to get roasted 17%, while the Dow, S&P, and the Nasdaq went sideways to higher, is a very interesting phenomenon. So I was watching it very closely, and sure enough, we popped above it the first week of June, and we broke above this declining red line here on about June 7th. And I've highlighted the breakout in this oval that's highlighted in yellow. We rallied up and just kind of we had a little bit of bumps in the road here, but we've been holding, and we're looking really good. The 5-day moving average in red is above the blue 20-day moving average, and the 20-day moving average is above the purple 50-day moving average. So currently we have a short-term strength confirmation with the 5 above the 20, and an intermediate term strength confirmation that was generated on June 21st, when this 20-day moving average crossed above the purple 50-day moving average. So right now you have an index full of excellent companies with the breakout and short and intermediate term strength. So right now I'm very pleased with this staples stock index at this time. Here's the S&P 500 Industrials stock index, and this index is looking very bearish at the moment. We had a peak up here on June 11th, and then we just sold off very fast. Came right down here, and I don't know how many down days in a row, but about 2 weeks of almost solid selling. The 5-day moving average in red is pointing very steeply to the downside, crossing below that blue 20-day moving average, triggering a short-term weakness confirmation, and that 20-day moving average in blue is rapidly heading toward crossing the purple 50-day moving average, which would be a intermediate term weakness confirmation as well when that happens. So if I draw some resistance lines in here to kind of give you a sense of what has been going on with this, this was the high, the prior high of May 21st, and you can see the industrials rallied up and just basically tagged it and rolled right back down again. So we have several areas where that provided some resistance. Right here was one of them on March 21st, and this actually, I believe, rallied up there and tagged it on April 18th. So we had several points at which this particular index failed at that same point, and we failed again, and it's looking very bearish for industrials at this time. So use a lot of caution on the industrial index. One other note on the industrial index is the prior downtrend line has also been broken, which is very bearish. Let me draw that line in here for you. We draw a line from the tops of February 26th all the way down. Let me get that line going. There we go. And you can see that we draw a line from the high of February 26th. We came up, tried to break it on March 9th, failed, fell all the way down, rallied up, tagged it again on April 18th, and failed very, very significantly. Rallied up again, broke it, came back down, touched it from above once, came up, tested again twice, rallied up, and then hit that prior high that I already talked to you about, which was this one, and then just rolled over. Now the problem with this index is now we are below that declining trend line. So this whole endeavor here for the months of May and June has been a false breakout, it looks like, and the door is open to lower prices for the industrial index at this time. Here's a chart of the Dow Jones Financial Stock Index, and this particular index is also very bearish. You have the 5-day moving average in red is crossed below the 20-day moving average in blue, triggering a short-term weakness confirmation, and the price just continues to fall, and we still have the 20-day moving average and 50-day moving average going sideways, which is a sign of indecision, but that price is falling rapidly, and if it continues, I would expect that 20-day moving average to start to turn lower and head toward crossing that 50-day average in the next couple weeks. One thing I want to point out is we're back below the declining trend line from the highs of January 26th to the highs of March 9th. We touched it here on May 10th and May 11th, broke above it briefly and then failed back in, it's like late May. We broke above it on June 5th, rallied up here, and then rolled over again, and now we have failed again, and we're back below that declining trend line. So this whole endeavor for the last 3 weeks appears to be a false breakout. And also, as far as support goes, let's draw a line along these bottoms from March 23rd up to May 4th and beyond. And you can see that we have also failed to hold that support line as well. So this got touched there and got touched there, and we came down, tried to close on it back on the 25th, but really gave it up on the 26th and closed below that support line on the 26th. So financials are looking very bearish at the moment, and I would definitely use a lot of caution on this thing until it changes direction. Here is a chart of the Dow Jones Healthcare Stock Index. This too is starting to look bearish, but just in the most recent week anyway. We also came against some pretty significant resistance in this particular index. And if you draw a line from the high of March 9th, you can see that healthcare rallied up, got to the line, and then rolled over again. So that line, this high, from March 9th is providing some very significant resistance to the healthcare stocks, and the 5-day moving average is rolling over and heading toward a crossover of the 20-day moving average in the near future if this continues. And we do have a lot of intermediate term strength though. The 20-day moving average in blue is pulling up and away from the 50-day moving average in purple. So right now things are just kind of partly cloudy for the healthcare stock index. We need to see some confirmations here. The 5-day average needs to cross the 20, and the 20-day moving average needs to start to head lower before I can start really using the word caution. But this peak and decline that began on June 15th is a little concerning to me. So use some caution, but we don't have any weakness confirmations yet for healthcare. Thanks again for watching this market update. I hope you found the charts and information useful. Before you go, please do me a favor and click the subscribe button on this YouTube channel if you have not already, and then click the little bell next to it so you will be notified whenever additional videos are posted. And in the summary description of this YouTube video, you can find links to the Facebook, LinkedIn, Twitter, and YouTube channels and pages for Christensen Wealth Management, as well as the website. Please visit those when you have time, and if you have not, go ahead and like or follow those pages while you are there. That way, throughout the week, I can communicate with you through videos and through social media. Well, have a great day and another great week, and look forward to seeing you again in about another 7 days. Bye-bye.